Okay, so hello and welcome to CN Professional Institute. We are still on IFRS 15 revenue from contract with customers. In the previous video, we looked at the first step, which is to identify the contract with the customer. We looked at step 2, identify the separate performance obligations. And then we also looked at step 3, determining the transaction price, right? And we also looked at the factors that can affect the transaction price. Okay, so we looked at this one, we looked at the first one, which is the financing element. So we looked at the financing element and how it affects the transaction price. We looked at non-cash considerations, right? So in this video, we are going to continue with the variable consideration, and then we'll look at consideration payable to customers. So we are still on step 3, determining the transaction price. So let's continue with the variable consideration, right? So we said there is variable consideration when the recognition, or there's a variable consideration when that consideration is based on the occurrence of something, when that consideration will be recognized if the entity meets certain condition, right? So variable consideration comes with certain conditions that must be met, and we only recognize consideration only when those conditions are what met. So let's get an example. Let's say there's a contract between two parties, right, to build a house. So one party will build a house to the other party, right, at let's say 2 million, right? So at 2 million. So the consideration here, or the main consideration is what? 2 million, right? But there's also a variable consideration that, okay, if the building is completed, if the party can complete the building in, let's say, 18 months, right, they will be entitled to additional 1 million. Are you following? So the main consideration is what? 2 million. But there's another condition that if they are able to complete the building in 18 months, right? In 18 months, they'll be entitled to another what? 1 million. So this 2 million here is the first consideration, and the 1 million is the variable consideration. So this consideration will be recognized if the condition is met, if they're able to complete the building within what? 18 months. Right. So variable considerations are dependent on certain conditions, okay, on adherence or occurrence of certain conditions. And if the entity is able to meet those conditions, then they can record or recognize what? Variable consideration. Right. Very good. Now, when do we record variable consideration? Right. IFRS 15 says that we should record or recognize variable consideration, right, if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. When the uncertainty is resolved. Now, what do we mean by this? This IFRS 15 says we should record variable consideration only when it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. Now, this is what it means. It says before you record a variable consideration, the entity should be very, very sure that if they add that variable consideration, if they include that variable consideration, okay, as part of the main consideration, if they record a variable consideration in their books, how probable are they that they will meet the conditions? How probable are they that they will stick to the terms, and that when they record the variable consideration, they will not go back and reverse it. They will not go back and reverse the revenue they've recorded. So for an entity to record a variable consideration, they must be very sure it is highly probable that they will meet the conditions. Are you following? That they will stick to the terms, and that when they record it, they are very sure that they will meet the terms and then they will not go back and reverse. So with the example I've given you, looking at this example, the example I've given you here, that the main consideration is what? 2 million. But if they're able to finish building within 18 months, they will receive another what? 1 million. In that case, they only record the 1 million as variable consideration only when they are sure they have everything in place. They've done it before. They are very sure that they will finish the building in what? 18 months. So it could be that they have been able to work on similar buildings and they've been able to complete within a short period of time. So they are very certain that when they start, they can finish in 18 months. The science says it is only so, it is only then that they can record the 1 million. If they are not certain, if it's not probable, if the circumstance surrounding them will not permit them to finish within 18 months, then they cannot record the 1 million. So we only record variable consideration only when we are certain that we'll stick to the terms, and then we'll not go back. If we record the variable consideration now, we'll not go back to record, or we'll not go back to reverse, okay, it, because we've not met the conditions. So we should only be sure that we meet the conditions before we record the variable consideration. Okay, so that's variable consideration and how it affects the transaction price. Okay, let's look at an example here. So it says on 1st December 2021, LN provides a service to a customer for the next 12 months. The consideration is 12 million. LN is entitled to an extra 3 million if after 12 months, the number of mistakes made falls below a certain threshold. Required. Discuss the accounting treatment of the above in LN's financial statement for the year ended 31st December 2021. If A, LN has experience of providing identical services in the past, and it is highly probable that the number of mistakes will fall below the threshold. And B, LN has no experience in providing this service and is unsure if the number of mistakes made will fall below the threshold. So A has given us the condition. So scanning to the question again, the main consideration is 12 million. So that one is setting the question. The main consideration is what? 12 million. So that one, we can see it, 12 million. Very good. But they are entitled to extra 3 million, right? If after 12 months, the number of mistakes fall below a certain threshold. So this 3 million here is what we call the variable consideration. It is based on something. It is contingent on something. I follow. If they are able to reduce the mistakes to the minimum, that's when they record the 3 million. So the 3 million is what we call the variable consideration. If you come to A, for the 12 million, the fixed consideration, that one is cool. We will record it. But the issue is, should we record the 3 million as a variable consideration, or we shouldn't? So A is saying that, okay, they have experience in providing identical services. So it is probable that they will meet that requirement, and it's probable that the number of mistakes will fall below the threshold as spelled out in the question. So the start is saying, okay, if they are very probable, or if it's highly probable that they can stick to the terms, that they can provide the service, okay, and the number of mistakes in the service will fall below the threshold, then they can record the revenue, because they are very certain that a significant reversal in the cumulative amount of revenue recognized will not occur. So if they recognize or record the 3 million as variable consideration, they will not go back, and it's very probable, it's highly probable that if they record the 3 million variable consideration, they will not go back and reverse, because A is saying they have experience. So they are certain that if they record it, they will not go back and reverse. I following. So A meets the criteria or the condition for us to record the what? The variable consideration, because it's very probable that they will stick to the terms, or they will reduce the number of mistakes, and therefore they can record the variable consideration. So in this question, the consideration is 12 million, the main one. So for A, we'll add the 12 million to the 3 million variable consideration, right? But don't forget, this is a service, okay? And look at it. When did the service happen? 1st December 2021. Are you following? And we are preparing the extract as at 31st December. If you look here, as at 31st December 2021. And service is likely to happen over time. You don't just do it for, let's say, that day. You don't only do it that day and stop. It's supposed to accrue throughout the period. Are you following? So services. So if you look at this question, we say, okay, I said we said 12 million is the variable consideration, 3 million is the fixed consideration, right? Which is depending on the number of mistakes. That one we said for A, they are certain that they will meet the conditions so they can record revenue. Are you following? Now, one thing we should know is that this is service. Are you following? This is service, and it is likely that the performance obligation will happen over time. As I said, it will not happen at a point in time. The service will not be done just today and then that's it. It will happen over time. So they'll be doing it along. They'll be doing it along. Are you getting it? For the next 12 months. Every month, let's say every month they'll do it, every month they'll do it. So we don't just record revenue once. We have to spread it over time. That's the performance obligation what? Over time. Are you following? So we don't have to record everything once. We have to divide it by the 12 months. And we record every month, we record revenue monthly. So every month we record what? Revenue. So that is all. So let's go and solve it. So with A, okay, we said that the transaction price, okay, we said the transaction price here will be the 15 million plus what? The 3 million. Oh, no, let me check. So let me check the question. Sorry, it's not 15. Okay, it's 12 million. Okay. So the fixed consideration is 12 million. So we have to record a fixed consideration of what? 12 million. So it's a 12 million fixed consideration plus the 3 million variable consideration. That's for A. Okay, so when you divide, when you add the 3 million to the 12 million, we are going to get 15 million. And this 15 million is the revenue that we are going to record, which includes both the fixed consideration and the variable consideration. But we are saying this is service. Okay, so it's likely that the performance obligation will be over time. So we don't have to record everything. We have to divide it by what? 12 months. Because if you look at it, the service is from 1st December 2021 and the year in 31st December. So you have to record only 1 month revenue. Okay, 1 month revenue because 1st December, 31st December, only 1 month. So we are going to divide the 15. So the revenue to recognize will be 15 divided by what? 12. Okay, so we said we divide the 15 by 12 months because we said this is what service and it's likely that performance obligation will be satisfied over what time. So 15 divided by 12, which gives us 1.25, right? So in relation to A, we are going to record revenue of 1.25. Why? Because we said Ellen has experience in providing what identical services. Okay, and it is probable that the number of mistakes will fall below what the threshold. So it means that if we record or if we include the variable consideration of 3 million in the transaction price, it is very probable that we will not go back and reverse the cumulative amount of what revenue that we've what recognized. They have experience, so it's what highly probable that they will not go back to reverse the amount of revenue what recognized, right? So we include the variable consideration as part of the main consideration or as part of the consideration, right? And we say we are divided by 12 because this is service and it's likely that performance obligation will be over what time. So we'll spread it, okay, over the 12-month period. B, we are told that Ellen has no experience of providing this service and it's was unsure if the number of mistakes will fall below the threshold. So they don't have experience, right? So the science is saying, okay, if you don't have experience, then how probable, how likely is it that they will meet the condition and that the number of mistakes will fall below the threshold? If they don't have experience, then it's not probable, okay, that they can meet the condition, okay? If they have experience, it's not probable that they can stick to the terms and then reduce the mistakes below threshold. And therefore, they cannot record a 3 million as variable what? Consideration because it's not probable, okay, that if they record a revenue, it's not probable that they will not go back to reverse. Are you following? Because they have experience. So it's very unlikely that they can meet the threshold, that they can let the number of mistakes fall below the threshold. So with the B, we are not going to record the 3 million as part of what the variable consideration. We are going to record only the 12 million. So in that case, our transaction price will be what? Only the 12 million. And that one too is the same. We have to divide by 12 months. Okay. And record only 1 month revenue. So we divide the 12 million, okay, by 12 months. And we have what? 1 million. So 1 million is what we are going to record as the variable I'm sorry, as the transaction price or the revenue. So I'm going to write, we are going to record 1 million as revenue in our books, and we are saying that we are not recording the variable consideration of 3 million because we're told clearly that they don't have experience. So it's very likely that if they record a 3 million, it means it's likely that they will not meet or they will not be able to meet the condition. Okay, and therefore we don't want to go back and reverse. We don't want to record revenue and later go back and reverse. That's what the standard prohibits. So if you are not sure, if it's not highly probable that you will meet the condition, then don't record, because we don't want to go back and reverse the cumulative amount of revenue that we've recorded. So since they don't have experience, we don't have to record the 3 million variable consideration. We have to record only the 12 million fixed consideration. So we are going to record only 1 million as revenue. Consideration payable to customers. Consideration payable to a customer. We are still looking at factors that can affect the transaction price. Factors that can affect the transaction price. So we look at, looking at the financing element, we look at the non-cash consideration, then we looked at variable consideration, and then we are going to look at consideration payable to a customer. So we are still on step 3, determining the transaction price and factors that can impact the transaction price. So let's look at consideration payable to a customer. It says if consideration is paid to a customer in exchange for a distinct good or service, then it is essentially a purchase transaction and should be accounted for in the same way as purchases from suppliers. So if you pay an amount of money to your customer, let's say you have a contract with the customer, okay, any consideration you pay to a customer, are you following, in exchange for goods, it says we should treat it as a purchase. So you pay 2 million to your customer and your customer is giving you goods back. Maybe you before even this, you had another contract, you have a different contract with the same customer, right? But with that contract, it's different. Now, you pay the consideration of, let's say, 2 million to the customer, right? The customer is giving you goods in exchange. If the customer is giving you goods in exchange, any consideration or any amount of money that you give to the customer, and the customer is giving you goods in exchange, record it as purchases, like you're buying from the customer. Are you following? You don't have to go and deduct it from the previous contract transaction price. So before this, let's say before this one, you had a different contract with the customer. That one's a different contract. Are you following? Now, you pay the consideration, a different consideration to the customer. But this consideration that you are paying to the customer is giving you goods in exchange, or will give you service in exchange. The sign saying if that's the case, then you have to treat it as a different purchase, as a purchase. Okay, treat it as a purchase. But where the consideration, okay, so let me try and summarize everything. What I'm saying is that if you pay a consideration to a customer, right, that consideration, if that consideration is in exchange for goods and services, record it as a purchase. If you pay a consideration to a customer and the customer will give you goods and services back, record it as what? Purchases, right? Assuming that the consideration paid to the customer is not in exchange for goods or services, the entity should account for it as a reduction in the transaction price. Okay, so this is what the standard is saying. Let's say you entered into a contract with the customer for 10 million goods. Okay, so goods 10 million. So the customer is buying goods worth 10 million from you. Are you following? The customer is buying goods worth 10 million from you. Now, if the customer is buying goods worth 10 million from you, this 10 million is you receive this 10 million. Okay, you receive this 10 million as your revenue. But let's say there's a separate contract, or let me say there's a separate contract with the customer, and in this, the same customer. In this case, okay, you pay 2 million to the customer. The standard is saying, okay, even though you sold goods worth 10 million to the customer and the customer will be giving you 10 million, there's also a contract with the same customer where in this case, you, okay, are giving 2 million to the customer. The contract is you sold goods worth 10 million to the customer, so you have to receive 10 million from the customer. But there's the same contract with the customer when in this case you are paying 2 million toward the customer. So the sign is saying, okay, if this 2 million that you are paying to the customer is in exchange for, if it is in exchange for goods, if the customer will give you goods in exchange for these 2 million, since we record this 2 million as purchase. I follow me. Don't go and deduct the 2 million from the 10 million. Don't net it off. That the customer will be giving you 10 million. Okay. And you're also buying goods worth 2 million from the customer, so net it off. No, the seller is saying treat this 2 million as a purchase from the supplier, from the same supplier as a purchase. So you come and debit purchases in your books, okay, and you can credit your cash or your something. But if the 2 million, okay, that you are paying to the customer, this 2 million is not in exchange for goods, the customer will not give you any good in exchange. Then it says come and deduct it from this transaction price, from the amount expected to be received from the customer, that 10 million. So it says if the consideration paid is not in exchange for a distinct goods or services, then it should be accounted for as a reduction in the transaction price. So in that case, come and deduct it from what? The 10 million and record only 8 million as what? Revenue. Because you are refunding or you are paying 2 million to the customer and the customer will not give you any good in exchange. So that 2 million, go and net it from the 10 million that you are expecting to receive from what? The customer. So that's what is the saying. So maybe let's look at this example here. Okay, let's look at this example here. It says Roscoe or Rose Corporation, okay, enters into a contract with a major chain of retail stores. The customer commits to buy at least 20 million of product over the next 12 months. The terms of the contract require Roscoe to make a payment of 1 million to compensate the customer for changes to need to make to its retail stores to accommodate the products. By 31st December 2021, Roscoe has transferred product with a sale value of 4 million to the customer. How much revenue should be recognized by Roscoe in the year ended 31st December 2021? So if you examine this question very, very well, you would realize that the consideration paid, okay, or the 1 million refund. So this what it means. There's a contract to buy at least 20 million. And it says for every 20 million purchased, okay, Roscoe will pay 1 million back to the customer to compensate the customer. So it says the commitment, they promise to buy at least 20 million. And it says for each, for this 20 million, okay, for 20 million products sold to the customer, they will make a compensation. I mean, they will refund 1 million to the customer to compensate the customer. Are you following? For changes it will make to its store to accommodate the product. So you see, the 1 million refund back to the customer is not in exchange for goods and services. The stance is if this 1 million paid to the customer will receive goods from the customer, then we have to treat it as a purchase. But the 1 million that we promise to refund the customer, if the customer buys 20 million worth of goods, or for every 20 million buy, there will be 1 million refund. That refund is not in exchange for goods and services. So we can't treat it as purchase, but rather we treat it as what? A reduction in the transaction price. So we have to get the refund. So that's what it means. Every 20 million they buy, they'll get a refund of what? 1 million. Now we're told that by the end of the year, the customer bought 4 million. Roscoe transferred goods worth what? 4 million. So 4 million has been transferred to the customer. So if 12 million, 4 million is transferred to the customer, what will be the refund? So we just get the refund and we'll less it. Yeah, we are going to treat the refund as what? A purchase, because it is not in exchange for goods and services. We are just refunding the customer for the changes it will make to his stores. So it's like the refund is a compensation, not in exchange for goods. So we have to get the refund and deduct from the transaction price. So the question is, so let's solve it. It says for every 20 million. So we can do this way. We can do it two ways. First method is the question said for every 20 million worth of goods purchased or transferred, they will refund the customer 1 million, right? So if for 20 million goods, if for every 20 million worth of goods transferred, they will refund the customer 1 million. Then it is by the year end, we have transferred goods worth for 4 million to Rose, to the customer. So Rose has sold goods worth what? 4 million. So for this 4 million, what will be the refund? X. I follow. So we are just using ratio and proportion. If we promise that for every 20 million, we make a refund of 1 million. For the 4 million, what will be the refund? So we just do cross multiplication. So 20x is equal to 4. So if 20x is equal to 4, then we divide here by what? 20 divided by what? 20. So we see that our x, okay, will be equal to 0.2. So 0.2 million is the refund that we are going to give to the customer. Are you following? And the standard is saying that this refund should be treated as a reduction in the transaction price because the refund is not in exchange for goods and services. If it was to be in exchange for goods and services, we would have treated this as purchase. We would have treated the 0.2 as purchases. But because it is not in exchange for, goods, we will reduce it from the transaction price. So we sold goods worth 4 million minus 0.2, which will give us 3.8. So 3.8 is the revenue that we have to record, not the whole 4 million. Or method 2, okay, we promise that, okay, for every 20 million, we will refund what? 1 million. So let's get the percentage of the refund of the total transaction price. So in that case, we are going to have, we are going to have 1 million, the refund over the total contract price by 100. I follow by 100, which gives us what? 5%. So we are saying that, okay, for every goods that we sell, we'll refund the customer what? 5%. Are you following? If that's the case, then for the 4 million we sold, what will be the refund? Are you following? So the refund will be 5 over 100 by what? 4. Are you following? Which should give us the same 0.2. So the refund is 0.2. So we go and deduct it from the transaction price. 4 minus 0.2, and that gives us 3.8 million. Are you following? Or we can do it this way. Now that we know that for every good we sell, the refund is 5%. Okay. If the refund is 5%, the 95% is what we are going to keep. Are you following? So pick your calculator and do 95% of the 4. Find 95% of the 4 million. Are you following? If you find 95% of the 4 million, you come and get this 3.8 straightforward. So 95% of 4 million will give us 3.8. So 3.8 is the revenue that we are going to record in our books. Okay. So that's it for step 3. So we are done. We looked at step 3. We looked at everything. Determine the transaction price. So now we looked at the variable consideration. We looked at financing component, non-cash consideration payable to customer. Let's go and look at step 4. So step 3, we've learned the transaction price and factors that can affect the transaction price. Let's go and look at step 4. Step 4 says we shall allocate the transaction price to what? Separate performance obligations. Allocate the transaction price to separate performance obligations. Now, what is the transaction price? We've learned it in step 2 and 3, right? So we said the transaction price is the amount you receive, okay, when you fulfill your performance obligation. Are you following? When you perform or you satisfy your performance obligation, the money you receive in exchange, the revenue you receive in exchange is the transaction price. Now, we also learned the performance obligations, how to identify performance obligations in a contract. We learned it in the previous video, right? So if you don't check that, you have to check it. You have to know how to treat or how to split performance obligations into individual performance obligations, right? This is allocate the transaction price to separate performance obligation. Before we start, let me give an example. Let's say you sell 3 goods, A, B, and what, C. You sell A alone for 5 cedis, B for 6 cedis, and C for what? 9 cedis. That's the amount you sell them if you sell them alone, right? But, so let's even sum it here. Okay, so 9 plus 6 gives us what? 15. 15 plus 5, 20. So if you sell them, each of them alone, you get 20 cedis. But this is what you do. You normally combine them so that you can combine the 3 and sell them for what? 15 cedis. Put all the 3 together and sell them for 15 cedis. This 15 cedis is what we call the transaction price. Are you following? A, B, C are the performance obligations, the separate performance obligations. These 5, 6, and 9 are what we call stand-alone selling prices. Stand-alone selling prices. So if you sell them alone, how much will you sell them? If you sell A alone, you sell for 5 cedis, B alone for 6 cedis, C alone for what? 9 cedis. So these things are called the stand-alone selling prices. Stand-alone selling prices. So if you are selling them alone, that is how much it will cost you. So we call them stand-alone selling prices. Now, what is happening here? We said if you should sell them alone, okay, if you should sell them alone, you sell them for 20 cedis. So 5, 6, 9, you sell them for 20 cedis. But because you are putting them together, you're selling them at for what? 15 cedis. There's something called discount. So it means you've given a discount of what? 5 cedis. Are you following? Because if you sell them alone, each of them, you get what? 20 cedis. But you place all the 3 products together and you are selling them for 15 cedis. So there's a discount of 5 cedis. There's a discount of what? 5 cedis. Are you following? So we said the stand-alone. So when you come here, it says the stand-alone selling price is the price at which an entity sell a promised good or service separately to a customer. So if you're selling it one separately to a customer, how much will you sell? Are you following? That is what we call the stand-alone selling prices. Okay. And it says the best evidence of a stand-alone selling price is the observable price of a good or service when the entity sells that good or service separately in a similar circumstance. So that's what they're saying. They're saying the standalone selling price is the observable price, okay? The price at which you normally sell to a customer. If the standalone selling price is not directly observable, then the entity must estimate the standalone selling price. So they are saying that, okay, the standalone selling price is normally the normal price that you sell your product, okay? The observable price at which you sell your product. It says if you cannot estimate the standalone selling prices, if you cannot estimate the standalone selling prices, they have to what? Estimate. That's what they're saying. Just use an estimation for the standalone selling prices. So we should know what standalone selling price is. This is the forces we should allocate the what? The transaction price to the separate performance obligation. So you see, we said the transaction price here is what? 15 million, if you remember, right? We said the transaction price is 15 million because that's how much you are putting the 3 together, A, B, C. You are putting all of them, you are selling for what? 15 million. So the sign is saying we should allocate, spread this 15 million, share it to A, B, and what? C. This transaction price. Okay, share it to A, B, and C. And that's what we call allocate the transaction price to separate performance obligations. Allocate the transaction price to separate performance obligations. So share this 15 to A, B, and C. And we said when the sum of the stand-alone selling price, okay, these ones here, when you sum them and it is more than the transaction price, then there's a discount. So don't forget that in the question, you always have to sum your stand-alone prices, compare, and then you see if there's a discount or not. So let's try this question. So we are told that Pius Limited sells 3 products at the following standalone selling prices. So put at A 40, put at B 55, put at C 45. Pile sells one each of the products to Niles for 100 cedis in total, right? Before we solve example 1, let's come and solve example 2 first. There's one example. Good. Let's solve example 2. We'll go back to solve example 1. Okay. Example 1 has a bit of complexity. It's not complexity per se, but you should be able to identify the said performance obligation. So let's look at example 2 first. Okay, example 2 is, let's say, simpler. So example 2 says Bright Limited sells 3 products, okay, at the following standalone prices. Okay, so sells A for 50, for 25, and 75. Products are not usually sold at a discount, but Bright agrees to sell each. I get in. Bright agrees to sell one each of the products to what? Y for 100 cedis in total. The products are delivered at 3 different points in time. The delivery of each product is a separate performance obligation. If you look at step 4, what we are just looking at now, this step, we shall allocate the transaction price to separate performance obligations. To separate performance what? Obligations. Are you following? So we are told that, okay, each of the 3 products, A, B, and C, they are separate performance obligations. Separate performance obligations. This question is telling us to allocate the discount. Are you following? And they say we shall allocate the transaction price. The step 4 is about allocating the transaction price. This 100 is the transaction price. So we have to share it to what? A, B, and C. But this question says we shall allocate the discount to the separate performance what? Obligations. Very simple. How do you do it? We said the first thing we do is we sum the standalone selling prices. We sum them up. So here, let's sum them up. So 50 plus 25 plus 75, right? Let's sum all 50 plus 75 plus 25. So when we sum all this, what do we get? Are you following? So when you sum this one, so 25 plus 75 should give us what? 100. Are you following? 25 plus 75 will give us 100. Then 100 plus 50 should give us what? 150. Are you following? So we have 150 as our sum of the standalone selling prices. So we realize that everything here sums up to what? 180. Sorry, 150. Are you following? The sum of the 3 is 150. But we are selling it for what? 100 cedis. Are you following? Everything sums up to what? 150. But we are selling it at what? 100. We are selling the 3 for 100. So can you realize that there's a discount? We've given a discount of what? 50. So there's like a 50 cedis what? Discount. And this question is saying we should allocate the 50 cedis what? Discount, not the transaction price. So we should allocate the 50 cedis what? Discount. So how do we allocate it? This is normal mathematics. Are you following? So just pick your standalone selling price, divide it by pick the standalone selling price, divide it by the total standalone selling price, and then you multiply it by the discount. That's all. So how do we spread the discount? So we have the products here. So we have the products A, B, and what? C. Okay. Then the standalone selling price here is 50, 25, and then 70 what? 5. So when you sum all, you get 150. Now the discount, how do we share it? The discount is 50. We've agreed that the discount is what? 50. Why? Because the sum of the standalone price is what? 150, and then the transaction price is 100. So what you do is you pick 50 here, divided by the total 150 times what? The selling times the discount. Are you following? So when you pick A here, A will be 50 here, divided by what? 150 times the discount, 50. Are you following? So when you do it, you get what? 17. That's the discount. So here, me say here is the stand-alone selling price. Let's make it SA. This one is a discount. And after we have taken the discount from the stand-alone selling price, we can get what we call the allocated transaction what price. as the transaction price or the standalone selling price after the discount. Are you following? So we said you pick 50 divided by 150 times what? Times the discount 50. Are you following? And you get 17 as the discount. So here we have a discount of what? 17. Then when it comes to B, take 25 divided by 150 and multiply by 50. So 25 divided by 50. Okay, 25 divided by 150 times 50. And that will give you what? 8. And when you come to C, it is 75 divided by what? 150 times the discount 50. And that will give us what? 25. So can you see we are sharing the discount? If you like, sum all the discount, you should get the total discount 17 plus 8 plus 25. 17 plus 8 plus 25 should give us the discount, which is what? 50. Okay. Then after we will subtract the 17 here from the 50 to get the allocated transaction price. So 50 minus 17 should give us what? 33. Then 25 minus 8 should give us 17. And then 75 minus 25 should give us what? 50. And when you sum this, you get what? 100. So can you see that we've shared the discount 50 as the question asks us to do? It says we should share the discount by following. We should share the discount to the separate performance obligations. So we've shared the discount by following. Share the discount between the separate performance obligations. So we have shared the discount. So this is how we share the discount. There could be a question where you'll be asked to rather share the transaction price, right? So we'll look at it. If you are sharing the transaction price, it will be the same thing. What you do is you pick the 50 for A. Just pick your 50 here. If you are sharing the transaction price, okay, pick the 50 divided by what? 150 times the transaction price 100. That's how we are going to do it. So it will be 50 over 150 times the transaction price. Then you come here, 25 divided by 150 times 100. Then you come to C, 75 divided by 150 times 100. That's all. So we can either share the discount or the transaction price. Here, the standard is saying we should share the discount. Okay. Then let's go and look at example 1. Let's come back to our normal example here. So we've been told that Pius Limited sells 3 products at the following standalone selling prices. So these are the standalone selling prices, A, B, C. Are you following? Now, we're told that Pius Limited sells 1 each. Pius Limited sells 1 each of the product to Niles for 100 cedis in total. Product B and C are sold regularly together for 60. The products are to be delivered at 3 different points in time. Pius Limited regularly sells product B and C together for 60 and product A for 40. First requirement is the delivery of each product. Does it form a separate performance obligation? So is the delivery of each product a separate performance obligation? Show how the discount will be allocated to the performance obligations. So it says here we should allocate the discount. And how would this change if the contract required delivery of B and C at the same time? Require the delivery of B and C at the same time. So once again, let's answer the I, right? Is the delivery of A, B, and C, does each of them form a separate performance obligations? Here, look at something. We're told that products B and C are sold together for 60 rand. And we are also told that the products are delivered at 3 different points in time. We don't deliver them together. They are sold at 3 different points in time. So we maybe sell A, we deliver A today, or then we deliver B another time and C another time. So we can say that since the delivery of the product happen at 3 different points in time, the products are delivered at 3 different points in time. Are you following? We can say they form different performance obligations. So here, probably we don't have the element to perform our test. If you remember the first step, we see that for performance or for separate performance obligations to exist, we said one, the customer should be able to benefit from the product alone or together with other resources. Are you following? And we said two, the delivery of each of the products should be separately identifiable in the contract. So here we can say that, okay, because they are delivered at three different points in time, maybe they said the delivery is separately identifiable in the contract. But if you don't worry yourself, there's no much clue to identify this thing. So we just say, okay, because they are delivered at three different points in time, they form a separate performance what obligation. Okay, so for the I, we can say yes. Okay, since the three are delivered at three different points in time, and we don't have much clue as to whether there's a separate contract covering them, we can assume that there's a separate contract covering them, and then they form a separate performance obligations. And the customer can benefit from each of them alone, put that A, put that B or C, either alone or together with other resources, right? Okay. Then B, we say we should allocate, show how the discount will be allocated. So here similar to the first example, we have to sum the standalone selling prices. So 40 plus 55 plus 45, right? So 40 plus 55 plus 45. So this should give us what? 140. So if you sell them alone, okay, if you sell them alone, we'll sell them at what? 140. But look at it, we're told that Pius combined all, okay, and sold it for what? 100. Combined the three and sold it for what? 100. So this 100 is what we call the transaction price. Are you following? And then this 140 is the sum of the standalone selling price. So we said there's a discount of what? 40. But if they should sell it alone, they will sell each of them alone, they will make 140 from the total three. But we are selling everything together at 100 cedis. So there's a discount of 40. So you have to share the discount of 40 to A, B, and C. To A, B, and C. So let's come here. So we have product. So let's bring the product here. Okay. Then let's bring this standalone selling price here. The discount and then the allocated transaction price. The product we have A, B, and what? C. What are the standalone selling prices? 40, 55, and 45. So we have 40, 55, and 40, what? 5. Then we said the sum is 140. How do we share the discount? The same thing we did. Pick your 40, the standalone selling price, divided by the total standalone selling price. So you pick 40, by following. Then you divide it by what? 140. So 40 divided by what? 40 divided by 140 times the discount, which is what? 40. Are you following? So 40 divided by 140 times 40. That's what we are going to do for all. B, you pick 55 divided by 140 times 100. Then C, you do the same. But there's one key to note here. Look at it. The standalone selling price of A is 40. I'm sure you can see it. So you have to pay attention. The standalone selling price, okay, for A is what? 40. So that's the standalone selling price for 40. But come here, we're told that product A is sold alone for what? 40. So can you understand the standalone selling price? What we are supposed to sell for is the same as the transaction price for A. The standalone selling price, we normally sell it for 40, and we regularly sell it for 40. iPhone, so the standalone selling price is 40, and we also sell A for what? 40. So do you know that for A, there's no discount for A? Then if you come to B, it says B and C, we put them together and sell them for 60. So we put B and C together and we sell them for what? 60. But if you sum the standalone selling prices, 55, are you getting it? Plus 45 will give us 100. So we normally put B and C together and we sell it for what? 100. Are you following? But see, so we said B and C, if you sell them alone, we sell them for 100 because that's the standalone selling price for them. But we have put them together and we sold them for what? 60. So the sum of the standalone price was 100, but I put them together and we sell for what? 60. So can you see that it is the B and C that attract the discount? A will never attract the discount because the standalone selling price is what? 40, and we normally sell it for what? 40. So for B, there's no discount. We might sell it alone for 40, so there's no discount for what? B. The discount goes to, sorry, there's no discount for A. Are you following? Because the standalone selling price is 40, and we normally sell it for what? 40. So there's no discount for what? A. The discount goes for what? B and C. We put B and C together and we sell them for 60. But if you look at the standalone selling price, is what? 100. So the standalone selling price for B and C, the 100 is more than the transaction price for B and C, which is the 60. So A will not get any discount. It's the B and C that attract the discount. Are you getting it? So when you come to the computation here, we said A will not attract the discount. So A will not get a discount. So here we 40. So the discount of 40 should be shared to B and C. So how B will pick 55 divided by what? So divided by 100. I following. So you sum these two. So the sum of the standalone price for B and C is 100. So 55 divided by 100 by 40. That's how we are going to share. That's what B will take. And then C will take 45. This 45 here. Divided by what? 100. The sum of the standalone price by 40. Okay. So B will take 55 divided by 100 by 40, and C will pick 45 divided by 100 times this. So you realize that this will have a discount of, B will have a discount of 22. So discount of 22. Okay, that's 55 divided by 100 by 40, 22. And then C will have a discount of 18. Are you following? Will have a discount of 18. That's the 45 here divided by 100 times 40 will give us 18. So you subtract here 55 minus 22 will give us 33, and then 45 minus 18 will give us 27. Are you following? So this is how we are going to share the discount, the 40 discount. This is how we are going to share it. A will never get a discount because for A, the standard selling price is 40, and we normally sell it for 40, so no discount. So the discount will go to B and C. So it's just normal mathematics. How do you share something? You pick the individual element, okay, divided by the total times the discount. That's all. So here you get discount of 40, and here you come and get what? 100. So that's how we share the discount between the three performance obligations. We said we said A will not attract a discount. Then let's solve B. B says, how would this change if the contract required B and C to be delivered at the same time? So we said if B and C are delivered at the same time, then B and C will form one. So let me add this. How would this change if B and C are delivered at the same time? Yeah. How would this change if the contract required delivery of B and C at the same time? So we said where B and C are delivered at the same time, then they form what we call the same performance obligation. Are you following? They form one performance obligation. They form one performance obligation. Are you getting it? They don't form separate performance obligation, but one performance obligation. Okay, so that's the only thing that changes here. That deliver at the same time. Okay, so they will form one performance obligation. So with so let me wipe this and then see if we can get space to do the B. Okay, so with B, we have only two performance obligations because we are going to put B and C together as one performance obligation. So we are going to have the product standalone selling price, the discount, and then the allocated transaction price. Okay, so the product here, or the performance obligations, we said we have A will be a loan because A is delivered at different points in time. A is delivered at a different point in time. We are using the same question. Okay, just that the B says, we should assume that B and C are delivered at the same time. I get in it. So if B and C are delivered at the same time, then A is delivered at separate point in time. So A will form a separate performance obligation. But B and C, because they are delivered at the same point in time, you see they form the same performance obligation. So we put B and C together as one performance obligation, but not separate performance obligation. So we put it here. Then standalone price for A is 40. Then B and C, sum them. Said this with B and C, if you sum the standalone selling prices, we have 100. So here's 100. And we said again from the question, A will not attract a discount because the standalone selling price of A is what? 40. Okay, the standalone selling price of A is what? 40. And A is usually also sold for what? 40. Are you following? Standalone price 40 is usually sold for 40. So A will not attract a discount. Then the whole discount of 40 will be given to B and C. Here we are not going to allocate anything because we've put B and C together. If they were not together, we would have shared between B and C as we did in the A. But here, B and C form the same performance obligation, or they form one performance obligation, not different performance obligations. So we put them together and we give them the discount. So the whole discount will be allocated to what? B and C. So when you subtract here, you get what? 60. And then here, there's no discount for 40. You sum here, you get what? 100. Discount is what? 40. Sum of this is what? 140. So this is how we share the discount. As simple as what? A, B, C. Right? Very good. So that's it. So in this question, we've allocated the discount. We have shared the discount, not the transaction price. So the topic or step 4 is about what? It says we should allocate the transaction price to separate performance what? Obligations. We should allocate the transaction price to separate performance what? Obligations. But the question asks us to allocate the discount. So we are doing what the question says. We are allocating the discount. But where the question asks us to allocate the transaction price, it will be the same thing. You pick the standalone selling price divided by the total standalone selling price. Then in this case, it will be times the transaction price. So in this question, it will be times the 100, not the 40. So the same way we allocate the discount, the same way we are going to allocate the transaction price, right? So in the next video, we'll look at one question involving the allocation of the transaction price, okay? And then we'll look at step 5, recognize revenue as and when performance obligation is satisfied. So I'll see you in the next video.